All right, welcome again. Let's see an example. Impact of dropping a segment. A company has three shops, R, S, and T, to which the following budgeted information relates. Shop R, S, and T, and total, all the figures are given in £1,000. So sales, and if we deduct variable cost from there, we'll get contribution. And if we deduct fixed costs, then we'll get profit or loss. So we can see shop S is incurring 10,000 loss. 60% of the total fixed costs are general company overheads. And as we saw in our previous slide, then these general company overheads are irrelevant. These are apportioned to the shops on the basis of sales value. The other fixed costs are specific to each shop and are avoidable if the shop closes down. So avoidable costs are relevant costs, which we should consider in case of making a decision. If shop S closed down and the sale of the other two shops remained unchanged, what would be the revised budgeted profit for the company? So let's see what's the impact of dropping S or closing S. So apportion fixed cost is 60%. So 60% of the total fixed cost is £200,000, and 60% of this £200,000 is general overhead. And these overheads are allocated or apportioned to the shops according to the sales value or sales revenue. So 60% is 120,000. And out of this 120,000, how much is for shop S? All right. So if you distribute this 120,000 between among three divisions based on their sales revenue, so total sales revenue is 1,500, and 400, 500, and 600, and 500 is for S. So if you consider the ratio, so what would be 500 by 1,500 out of 1,500? So 40,000 of the fixed cost is for division of the shop S. And a total fixed cost charged to division S is 70,000, and 40,000 is general overhead. So remaining 30,000 is avoidable fixed cost. So this is avoidable fixed cost, remaining 30,000. All right, so 70,000 total is total fixed cost, and 40,000 is general overhead. So the remaining figure is avoidable fixed cost. So shop S therefore provides a contribution. What's the contribution of shop S's contribution is 60,000, and so how much is the avoidable fixed cost? Is 30,000. Variable cost contribution of 60,000 less specific fixed cost 30,000. All right. So 60,000 minus 30,000 avoidable fixed cost relevant. So 30,000 is the contribution, remaining contribution of the division S. All right. So the effect of closing down shop S is that total budgeted profit will decline by lost contribution from S to 50,000. All right. So what will happen? You are losing remaining 30,000 because of closing S. So what is the current profit of is 80,000. So you lose 30,000 from S net. So actually, what would be your contribution? So this is the contribution that you are not getting. Okay, 60,000. So if you don't get 60,000, your contribution will be 220,000. And out of this 70,000, okay, how much cost you can save? Only 30,000 you can save. So if you save 30,000, so your fixed cost will still continue 170,000. So if you do 220 minus 170, your profit will be 50,000. Okay. So other way you can calculate. So your profit will go down to 50,000 if you close shop S. So if you continue shop S, your profit is 80,000. If you stop or close division S, your profit will be 50,000. So what's better? It's better to continue. Let's see another example. Whether we should drop or retaining a segment. The Regal Cycle Company manufactures 3 types of bicycle: a dirt bike, a mountain bike, and a racing bike. Data on the sales and expenses for the past quarter follow. So these are the information given relating to 3 different kinds of bikes and total. So sales revenue, variable manufacturing and selling expenses, and then we'll get contribution margin. Then if we deduct fixed expenses, what are the fixed expenses? Advertising. What is traceable? Traceable means that you can trace, that you can relate to a particular product, which is usually relevant. Depreciation of special equipment, and it is depreciation, right? Usually depreciation is a relevant cost. Salaries of product line manager, right? And allocated common fixed cost, and common fixed cost is usually irrelevant. So there is a star here, allocated on the basis of sales dollars, right? So total fixed cost, if we add all this together, total fixed cost, and if we deduct total fixed cost from total contribution, then you will get operating profit or operating loss. Okay, so we can see racing bikes are in loss. Management is concerned about the continued losses shown by the racing bikes and wants a recommendation as to whether or not the line should be discontinued. The special equipment used to produce the racing bikes has no resale value and does not wear out. All right, so what is special equipment has no resale value. That means you can't sell it. And if you can't sell it, what will happen? It will stay in the business, and though you don't use, your depreciation will continue. So if you use, your depreciation will continue. If you don't use, your depreciation will continue. That means if you close the shop, your depreciation will still continue. That means this is irrelevant because it is not changing. And obviously general overhead is also the same, will not continue, will not change, will continue. All right. So what's the question? Should production and sale of the racing bikes be discontinued? Explain and show computations to support your answer. So whether this division should close or continue. And the second question, recast the above data in a format that would be more usable to management in assessing the long-run profitability of the various product lines. So this income statement actually shows that racing bikes is in loss. So is there any other way that we can prepare our income statement so that we can see the appropriate or accurate performance of the divisions or the products? So let's see whether the racing bikes should discontinue or continue. So based on our analysis, we can say that if we close it, we would be in loss. So that means the recommendation is no, the production and sale of the racing bike should not be discontinued. That means it should continue, right? Production should continue. If we discontinue, then we would be at loss. So what's the analysis? If the racing bikes were discontinued, then the net operating income of the company as a whole would be decreased by 11,000. All right. So how it came? So lost contribution margin. If we discontinue racing bikes, this is the contribution margin we will not get. That means this sales will decrease, this variable cost will decrease. That means ultimately this contribution margin will decrease. We will not get this 27,000. So this is the benefit we lost. Okay, this is the benefit we will lose. So this would be our loss. So what would be our benefit? So this is the loss. Okay, contribution loss. So what are the benefits? What are the costs we would be able to save if we close racing bikes? So the fixed cost that can be avoided: advertisement, that is traceable. As I mentioned before, traceable means is relating to a particular product that we can identify, that we can relate to a particular product. So if the product is closed, we don't need that. So the 6,000 this 6,000 we can avoid. As we mentioned before, this is the equipment we can't sell, so depreciation will continue. This is irrelevant, and this is irrelevant. And this is the product line manager's salary. So if we close the product, we don't need the production manager. All right, product line manager. So if we don't need the production manager, we don't need to pay him. So this is what we can save. So these are the two costs that we can save. So our savings, if we close racing bike, our loss is 27,000 contribution, and our savings, the cost that we can save, is 16,000. So what we can say, our saving is lower than loss. So ultimately 11,000 loss if we close racing bike division. So that means company should not discontinue racing bike division. So is there any other way that we can present the information to evaluate the performance of the divisions? So yes, we can recast the data based on the cost which are relating to particular division. So these are sales variable expenses. If we deduct, then we can get contribution margin, and these are the costs relating to the particular product. Okay, and depreciation, this is also relating to this division, and salaries of the product line manager is also relating to the divisions. All right, so these are the traceable fixed expenses. Okay, and the common fixed cost is actually is not relating to particular division, is the head office expense. All right, so we can just charge the expenses relating to the division on the division. So, and we can say our traceable fixed cost, or the fixed costs that are relating to the products, are this. Okay, not the common one. We are not considering the common fixed cost. We are not charging the fixed cost on the divisions, on the products. So what we can say, we can now say that the racing division is a profiteering business. So earning profit is not a losing business. So the racing bikes are giving 3,000 profits after incurring all of its own expenses. Okay, so what about the head office expense? Head office expense altogether is 60,000. That is charged on the total, only on the total column, 60,000. So the total profit of the company is 32,000. So the total company's profit is 32,000, is same, but the information which we can see based on the recast of the information, we can see all the products are actually profiteering. Racing bikes is not a losing product. So if we present this information in this way, that is, the costs and revenues of a particular product is presented against that particular product, right? And that's why we can see that the accurate performance of the products, right? and the head office expenses or the common fixed cost or the general overhead is being charged in the total column. That is the total profit of the company. All right, make or buy a component. Another example, and you will solve similar kind of example in your seminar as well. So if you understood these questions, you'd be able to solve seminar questions. And if there is any questions on this or on the seminar question, you can ask your tutor or you can contact with me. So let's see, Troy Engines Limited manufactures a variety of engines for use in heavy equipment. The company has always produced all of the necessary parts for its engines, including all of the carburetors. The outside supplier has offered to sell one type of carburetor to Troy Engines Limited for a cost of 35 per unit. All right. To evaluate this offer, Troy Engines Limited has gathered the following information relating to its own cost of producing the carburetor internally. So what's their production now? They are producing 15,000 units. So if they produce, what's their cost? This is what they gathered together. So direct material, 14 pound per unit, $14. Direct labor, 10 pound or $10. Variable manufacturing overhead, $3. Fixed manufacturing overhead traceable, okay, relating to this particular product is $6. And fixed manufacturing overhead allocated, this is general, $9. All right, so altogether, if we see, if the company if Troy Engines make this carburetor, then the cost to this company is 42. And they got an offer from another outside supplier, right, for 35. So if they purchase from outside supplier, it will cost them 35. If they make, total cost now comes to 42. And out of these traceable fixed cost, okay, 1/3 is relating to supervisory salaries. All right, so 1/3 and 2/3 is for depreciation of special equipment and which has no resale value. So 2/3 is relating to depreciation. So that means 2/3 means 4 pound is irrelevant. That will continue because it is depreciation and you can't avoid it. And 1/3, that is 2 pound or $2 is supervisory salary. So if you don't have the product, if you don't make it, you don't need supervisor and you don't need to pay it, so that you can avoid. All right, so 2 pound is relevant, right? $2 of this $6 is relevant and remaining $4 is irrelevant. Assuming the company has no alternative use for the facilities that are now being used to produce the carburetors, should the outside supplier's offer be accepted? So if the facilities where the company is now producing the carburetors will remain idle, there is no alternative use. If you assume that, so whether the company should accept outside supplier's offer or reject it, should they produce or should they buy from outsiders? So let's see what will happen if they make and if they buy. So cost of purchasing, if they buy, it will cost them 35 per unit. And for 15,000 units, what would be the cost? 35 times 15,000. So 525,000 would be their total buying cost if they buy from outside supplier. And what will cost them? What's the relevant cost of making those carburetors? If they make, they need raw material. Per unit, 14 pound. And what will happen if they make 15,000? So multiply by 15,000 times 14, 210,000. Direct labor per unit. If you make it, you need direct labor. So 10 pound times 15,000, so 150,000. Variable manufacturing overhead, you need that. You can't avoid it. If we make, you need this. If you buy, you don't need it. So this is relevant again. 3 pound times 15,000, so 45,000. Fixed manufacturing overhead, but obviously you should consider only traceable. Only the cost that you can avoid. So 6 out of 6 pound or $6, 1/3 is supervisory salaries. And if you make it, you need supervisor. If you don't make, you do not need supervisor. That means this part is these $2, that is 1/3 is relevant because it is avoidable, right? If you don't make, you do not need supervisor and you can avoid it. All right, so £2 is $2 is relevant cost, but the remaining £4 or $4 is what is irrelevant. Why? Because that is depreciation cost, and the equipment you can't sell it, right? If you can't sell the equipment, that means that depreciation will continue even though you are not using, even though you are not making. So if you make, depreciation is continuing. If you don't make, depreciation still continue. So that is, there is no change in depreciation. So relevant cost is which changes between alternative. So the 2 multiplied by 15,000 is 30,000. All right, and the common fixed cost, obviously, as we said, will continue, is irrelevant cost. So if you add all this together, you can see per unit cost of making is 29, per unit if you buy is 35. So if you make, you can save £6 per unit, $6 per unit. So multiplied by 15,000, that is $90,000 you can save if you make. But if you buy, you have to spend 20,000 more. So if you buy, your total expenditure is 525,000, but if you produce, your total cost will be 435,000. So what you should do, you should make, not buy. But if the facilities where you are making the product, if it has alternative use, what will happen in this case? What will happen? The second question is, suppose that if the carburetors were purchased, if you purchase from outsiders, the Troy Engines Limited could use the freed capacity to launch a new product. If you buy from the outside supplier, so your capacity will remain free. Your labor, your facilities, factory spaces that you can use for producing something else. So if you can do that, what will happen? The segment margin of the new product would be 150,000. So if you make another product, right? If you buy carburetors from outsiders and the facilities you are using for making another product, and what will happen? By making another product, you can earn net 150,000. So if this is the case, should you buy the carburetors from outsiders, or you should still make it? So let's see what happens. So from these calculations, we got 29 and 35, 435,000 and 525,000. All this calculation is still the same. Only one additional factor, that is the opportunity cost, we should consider further for the next requirement. So the total cost for buying is 525, total cost for making is 435, and this is the opportunity cost. When this is the opportunity cost? Opportunity cost. If you make carburetors in your organization, you would not be able to make the new product. And if you don't make the new product, you are losing 150,000. Do you understand? So if you buy from outsiders, this 150,000 is your revenue. you will earn it. But if you don't buy, if you make, then this 150,000 you will lose. So this is your cost. If you make, then your carburetor cost is this, but you would not be able to produce the new product, and you are losing 150,000 from the new product because you are not making that. But you can get this 150,000 if you buy. So this would be revenue if you buy, but this would be your cost if you make, because you are not getting this money. All right. So the total cost come to make is 585,000, and if you buy, your total cost is 525,000. So if you can see now, you'd be able to save 60,000, right? If you buy from outsiders. So if you don't understand this 150,000, right? If you say, oh, this is revenue, you can show here, this is opportunity revenue. All right, this is opportunity revenue. You can show it here as well. So when it is opportunity revenue, if you buy, then only you can earn this money. So you can show here, this figure as opportunity revenue. So if you show this figure as revenue here, so this is revenue and this is cost. So you have to deduct this amount from here. This is cost, and this figure, if you show here as revenue, you have to deduct it. And then you can compare what would be the total making is 435, and then what would be your cost of buying. And again, you will see the same difference. All right, so another way you can show as well. Right, okay, so the last problem. Let's see, evaluating a special order. Imperial Jewelers is considering a special order for 20 handcrafted gold bracelets to be given as gifts to members of a wedding party. The normal selling price of a gold bracelet is $189.95, and its unit product cost is $149. And altogether, how this has been calculated, 149 is this. So the production cost or product cost is direct material 84, direct labor 45, and manufacturing overhead is 20. And most of the manufacturing overhead is fixed and unaffected by variations in how much jewelry is produced in any given period. Most of the manufacturing overhead is fixed and unaffected. So if it is fixed, manufacturing overhead is fixed, that means it is irrelevant. So let's see what it says. However, 4 of the overhead is variable. So out of these 20, 4 is variable. That means 4 is relevant and remaining 16 is irrelevant. With respect to the number of bracelets produced, the customer who is interested in the special bracelet order would like a special filigree applied to the bracelets. This filigree, so the special order requires some extra work. So if it requires extra work, you need to spend extra money that you need to consider as well. That is relevant, that you have to incur in future. So this filigree would require additional material costing $2 per bracelet. So you have to spend extra $2 for every bracelet, and would also require acquisition of a special tool costing $250 that would have no other use once the special order is completed. So this 250 is a relevant cost because you have to buy if you accept this order, right? If you want to produce this special bracelet, you have to purchase this equipment, and you have to purchase this equipment only for this order. So this is relevant, though it is a fixed cost, but it is a traceable fixed cost. Traceable means this is only relating to this particular special order. If you make this bracelet, you need to buy it. All right, and after producing this special bracelet, this equipment has no other use. So the total cost is only for this order. So this order would have no effect on the company's regular sales. So the regular sales would be unimpacted, though you accept this order of producing what is called 20 handcrafted gold bracelets. Yeah, so, and the order could be fulfilled using the company's existing capacity without affecting any other order. So let's see what company should do, whether they should sell it at what's the price they are offering. Normal selling price is 189. Okay, so special order they are considering, so whether they should do. Okay, let's see. We are missing some information, I think. So what's the price the special order is offering? So they are offering 169. It should be somewhere, but it's not. I can't see it. Okay, so the special order price is 169.95, but the regular price is 189. Maybe I'm missing this information somewhere. So the special order, they are ordering, they want to give 169.95. Okay. So incremental revenue, what will happen if the special order is accepted? So this is what the revenue per unit, and for 20, if you multiply it by 20, this is what the total revenue you can accept, you can expect. So what are the cost? So the variable cost is direct material 84, you need this is variable cost. And what about for 20, multiplied by 20, 1680, direct labor 45 multiplied by 20, so 900, and variable manufacturing overhead is 4 per unit. All right, so multiplied by 20 is 80, and yeah, so out of, as the question says, out of 20 manufacturing overhead, only 4 is variable. So this 4 only we need to consider. Remaining 16 is not relevant. Special filigree is also a variable cost. It requires £2 or $2 per unit. So multiplied by 20 is $40 altogether. So 135 is the variable cost per unit, and total variable cost is 2,700. But you need a special tool that is a fixed cost, but it is traceable fixed cost only for this order. So you need to buy a special equipment for 250. So our total cost come altogether 2,950, and our increase revenue. If we accept the order, our revenue is this. If we accept the order, our expenses is this. So if the special order is accepted, 449 revenue will increase. So the regular business is not being affected. So it doesn't matter if you sell it at 169, it will give you 449 £449 or dollars as additional income. So that's good. You can sell, you can accept the order, and then you can sell it. And that's all. Thank you very much. And regarding these questions, if you have any question, if you have any problem, you can contact with me. You can ask Paul in your seminar. And thank you very much. And this was the last formal lecture. I would like to thank you very much for your support throughout the semester, and see you next week again with the review questions, and hope all the best for your final exam. Thank you.